Welcome to my first video on Thomas Piketty's Capital, where I will introduce the basic mechanics of Piketty's account of inequality, and in class we'll delve deeper into how he thinks that this theory shows a deeper pattern within capitalism. So before we begin, some context I think is very important. So the theory that we're discussing is actually the accumulation of a lot of work that Piketty, or Piketty, because he's French economist, that has collected a huge data set on a really huge data set on inequality to try and understand what are the patterns of inequality within various economies. So the book really is both trying to articulate sort of technical aspect of capitalism and how the relationship between components of production in a capitalistic economy and how that brings about increasing inequality. So what we want to do here is to try to understand some of the basic mechanics of that theory. Now, what I think is really important to stress is that we should try to understand it so we get a fuller understanding of what's happening. But even if we don't understand all of the aspects of theory, we can still get a very good understanding of one very important component of an economy that drives inequality. So first, the context. The assigned reading that I have given, Inequality in the Long Run, captures the themes of the book, Capital in the 21st Century. That's the full title of the book. But reading the whole book, as you've seen from the previous slide, is pretty thick. It's actually 696, nearly 700 pages long. So the goal here is really to sort of introduce the basic mechanics in part 1 and part 2 of this video. But before we do that, let's look at some facts about inequality. So between countries, inequality is pretty stark, right? So 10% of the richest people in the world own about half of the income. 1% own about 20% of the income. Within countries, the top 10% earns 32%, the top 1% earns about 9.5%. And in India, top 10% earns 55%, top 1% earns around 21%. And within countries, we tend to see quite significant divergences, partly because of differences in policies, differences in economic conditions, things like that. Inequality between countries has generally been rising. And another thing to note is that when we take on, as we will see in part 2 of this video, when we move not from calculating inequality just from income to focus on wealth, we see that wealth inequality is typically usually starker than income inequality. And that is a very important fact, according to Piketty, for understanding why inequality seems to be continually increasing. Here, this graph that I created, and you can actually create it if you go to the World Income Inequality database. You see a bunch of countries, US, South Korea, China, right? And you can see sort of general patterns of the distribution of income to the top 1%. And you can see one sort of very interesting pattern that note here is that there's a dip in the mid 1940s due to World War II, the devastation, and there's a sort of like general shock to the system. One very interesting thing that we're going to talk about more carefully in class is that you can see, right, from the around the 1990s here, right, to the 2000s, sorry for my squiggly writing, you can see the top 1% share, right, has spiked up in general, right? There's a general trend. So one question that Piketty is trying to answer is, what can explain this kind of general trend? Now, something I want us to sort of take note of is that this is not an academic concern within Singapore, right? So we've seen that the Gini coefficient has been growing in tandem with what we saw earlier, right? In the early 1990s, no, late 1990s to 2000s, but this has sort of been arrested a bit, right, in 2019, where the coefficient has dropped to its lowest in about 20 years, right? So that's almost exactly in tandem with the curve we saw earlier, right, where there's a lot of rising inequality, and then there's some policies in place to actually check that. Although we should note that some other measures don't also show that inequality is still a significant concern, right? So you can see that the difference between the top 10% and the bottom 10 decile in terms of income, average income, has actually increased, right? So from here 8,000, 11 to 13, and the rate of growth of income for the bottom 10 decile hasn't really grown much in tandem, right? If you just compare these two, so that's why the difference is growing more significantly. So Piketty really wants to answer this fundamental question: why is inequality increasing, and what is the primary reason for this increase? Now, one question you want to ask is, why is it important to even figure out the primary reason, right? As long as you have a plurality of reasons, that seems enough, right? And one reason why we want to figure out the primary reason is that it allows us to see what would be a more effective way of tackling inequality, right? So just here's an illustration. If we find that inequality is increasing because of a huge difference in the structure of the economy, such that there are a bunch of many well-paying jobs, and then low-paying jobs wages are stagnant and not increasing, then we need to change something about social mobility, maybe, right? And we will look at how we can think about these ideas next. But if we find that actually it's more about the nature of distribution of capital, right, as what Piketty is going to argue, then just fixing jobs alone won't get us far enough, right? So that's the kind of thinking why we should ask that question about what is the primary reason for inequality. So back to this question, the more sort of general question: why is inequality increasing? And Piketty wants to argue that it is because of the fundamental structure of contemporary capitalism, right? So what does that mean? We'll get to in a short while. And then the second question, as we already discussed, what is the primary reason for this increase? And he argues that it's the increasingly important role that capital has played in contemporary capitalistic societies. So, back to the first question, why is inequality rising? The answer was pretty vague: the fundamental structure of contemporary capitalism. This might as well be telling me that it's the fundamental structure of the universe, right? The two don't seem very informative, right? We need to sort of dig down deeper. And as an analogy, just like you might say, what's the fundamental structure of reality? Then you say, well, there are two fundamental laws, right? So Piketty also wants to see that there's sort of two fundamental laws governing how contemporary capitalism works. And the two laws are here. First of all, the first law is what is a sort of a strange law. It's not really, as we will see later on, a law about an empirical regularity like a natural law or something like that, right? But it's more about a definition of what he calls capital income ratio, or expressed in mathematical form, it is alpha. Alpha is the national income, meaning typically we can understand this as just simply as the GDP. R is the rate of return on capital, right? Meaning that if you invest, say $100 and R is 5%, then you can expect a return of $5, right? And then beta is the capital income ratio, right? Which is confusing, right? Because there's capital income ratio is defined by this dash and this is defined by the slash. But the capital income ratio, I'm going to explain what it is shortly. It's not that difficult to understand. It's basically in an economy, right? What is how much capital, if we add up all the stocks in the country and we compare it to the GDP per year, right? So the capital divided by the income, right? We're going to explain this in a bit more. But anyway, in English, right, the sort of important point is that in English, this formula, what does it tell us? It says that the share of overall income within an economy that goes to capital instead of labor, right? And we're going to explain what this means in a bit more detail shortly. But basically, we are asking, if we were to think about an economy, how much it grows and how much it produces a year, how much of that money or goods and services or whatever it produces, right, is due to capital, and how much of it is due to labor, right? And then the share of capital is basically the capital income ratio here is basically what share of that goes to capital instead of labor. Okay. Next, the second law, wealth trumps income, or beta equals S over G, right? So beta is the same thing here, right? As here, it's the exact same thing here, and that will be important as we see later on. And beta is again the capital income ratio. I'll explain what this means in more detail with an example. S is the rates of saving. Basically, if the economy is $1 billion, say produces $1 billion in the year, and the rate of savings 1%, right? Then the savings is 1% of 1 billion. And G is the economic growth, right? So the growth, maybe say, for example, in COVID is slow growth or negative growth, right? It might be negative 1%, it might be 5% in a year, things like that. Now, what does this thing here say? Basically, what this says is that in a country where you have high savings, right? Because this is the factor this is the denominator, right? There's a high savings and there's slow growth, right? Because it's over G, right? Wealth becomes disproportionately important, right? So the idea would be that when intuitively, if a country saves a lot, or companies also save a lot, right? Because companies can save money, not just individuals, right? The country is growing at a not very fast rate, right? Then wealth becomes increasingly important, right? Because wealth can accrue and can experience good capital gains or other kinds of gains, and then wealth becomes much more important to the economy overall. Okay, so let's actually look at the first law and what it means a bit more carefully. But before we do that, let's sort of like go into what capital and what income is first. Now, typically, if you do any sort of economics class, we think about capital in terms of it's being a factor of production, right? So if we have here, we can see that there are sort of typically 4 categories, although these are not sort of exhaustive, right? We have land, labor, capital, and one is also entrepreneurship, or the willingness to sort of see gaps within the market, things like that. Now, from a political economy point of view, right, we tend to focus primarily on these two things, capital and labor. And that's typically because, first of all, capital can buy you land, can pay labor, and can fund your entrepreneurial ideas. Right? So capital is sort of like the sort of like oil of the economy in a way, right? But of course, right, while capital can buy you land and it can fund your ideas, right, there must be a two-way system between labor and capital, right? So in other words, we tend to, in a political economy sense, we focus on people who have capital, people who can afford to buy land, to fund people's ideas or to fund their own ideas, right? And notice that capital is important. Capital can be, even if you don't have an idea, right, you can fund someone else's idea. So that's how it can work, right? And that's why, but then there's a division between capital and labor, right? And I hope that this is not something which is very unfamiliar. This is something which, since Karl Marx taught about the political economy, introduced these two important distinctions, right? Distinction between those who have capital and those who don't. Now, as we will see later, this is not just an theoretical or abstract it's not a theoretical or abstract construct, right? It also has sort of great significance in how we think about the nature of our economy. And in fact, it has great empirical significance because typically capital is quite unevenly distributed, and that has significant impact on the nature of the economy, as we're going to talk about shortly. So, as we already said, right, the primary focus is on income and capital, right, and their effect on the economy. And if we think about the first law, it's not really a law in the sense of a natural law where we are trying to explain certain natural phenomena. The sun rises in the east and sets in the west, that kind of law, right? It's more of an accounting identity that tells us, right, how we can calculate the share of capital to national income. So I'm just going to briefly illustrate this idea. Okay, so just now, as I already mentioned, alpha is the national income, meaning alpha is GDP. Right, now there's some problems with this, but let's just leave it there. Just as of like, just say that it's GDP. Okay, then now we know that beta is the capital income ratio. I've mentioned, I've said we will explain this, right? So how do we understand beta? So suppose that we added up all the stocks in an economy, right? All the people's investments and all the stocks, blah, blah, blah. But just for simplicity's sake, assume that this economy only has stocks. Okay, we add it all up, and it turns out that is all of these stocks and the holdings and blah blah blah, all the equity is 600 billion in the economy. Okay, then assume that the GDP of the country is 1 billion. So then we just take 600 divided by 1 equals 600. So that is our beta, right? It's basically, we calculate all the value of capital stock, which we've assumed is just stocks, in this case shares, right? I mean shares, right? Things that you buy, like Apple share lah, Amazon share, PayPal share, or whatever Singapore economy share, like Maple Tree share, things like that, right? Then we suppose, or GME stock, whatever, that's the kind of thing that we're talking about. And we calculate all those things, and now in this example is 600 billion over the yearly income of 1 billion, which is, so 600 divided by 1, 600, right? Then the rate of return is 5%, meaning that, as I mentioned, every $100 you put in, typically rate of return is 5%. Now you might say, how do we calculate this? Well, Piketty has shown using his huge data set that actually there's a sort of equilibrium rate of return about 5% for return on capital. But some people contest that, but in general there's a consensus that he's right? That if we look at a large set of data, rate of return capital sort of reaches at one equilibrium point of 5%. So beta is 600 right now. So then now we want to find alpha, right? So how do we get that? We do R, which we know is 5%, times beta, which we know is 600. So 5% times 600 is 30%. Now, let's look at, so here, the value of capital, the capital income ratio, right? With the slash, not the dash, right? The capital income ratio where you divide, right, is pretty high, right? 600. As we saw in the graph previously, immediately after World War II, there was a sort of dip, right? And that can be attributed partly to a dip in the capital income ratio. So then, immediately after World War II, that means 1948, 1949, where we have to rebuild the whole country and things like that, the value of capital stock was 300, right? So now we have 300, assuming again 300B over 1B, we have 300 again, right? And then the rate of return again is 5%, right? So obviously, because it's half, right? It's just half of 600, we will get 15%. Okay, so that is the first law, right? It just tells you that alpha is the share, right? That means in this economy, right, roughly, we can say that for every $10 that the economy makes, 30% of it is accrued or due to capital. In immediate post-World War II Europe, every $100 that the economy makes, $15 of that is due to capital. That's the basics of idea here. Now, you might ask, why should we care about this, right? Why should we even care about the percentage of what goes to capital, right? Let's get to that in the next video.